So a very good morning to everyone. I am Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. Welcome to the fourth episode of Investing Carva, a new Mission Smile initiative where we invite investing stalwarts every month and learn from their vast experience in the investing field. Before we begin, I would request everyone to please be on mute and switch off the video so that we can have a seamless discussion and soak in all the wisdom from Gaurav. So you may type in your question on the chat box, and in the end, we have 15 minutes scheduled for your questions. So let's begin. On this fourth episode of Investing Carva, I am really excited and consider myself fortunate to have Gaurav Sud as our guest today, and he's someone who I have been following for last 6-7 years. However, I was lucky to meet him personally, as in interact with him personally. And let me just start with a brief intro. Born in Shimla, Gaurav did his schooling from there, and after BTech from IIT Delhi, he went on to do his MBA from IIM Calcutta. He started his career with KPMG Corporate Finance, and since then, he has worked at Wipro BPO, KN Consulting, WNS Global Services, and Asian Oilfield Services. Gaurav is the managing partner of Kanav Capital for quite a few years now. Gaurav has maintained a very low profile all throughout. If you search on the internet, then you would just get an Economic Times article and an interview with Puneet Khurana of Stoic Capital and Manish Dhawan of Mystic Wealth. While I have been following him for 5-6 years now, I was fortunate to get introduced to him through a common friend. And I have requested that friend, Mr. Manoj Dua, to join today, and probably we'll hear something about Gaurav from him. Manoj, I have unmuted you. You can please go ahead.
Hi Gaurav. Hi Ankit.
Hi Manoj.
So I have known Gaurav for last 15 years, and Gaurav is a very smart and intelligent value investor. So we are a full-time investor, and all of the equities are as well known as the financial assets. So all our net worth is in equities. So as you know, the financial assets get very poorly priced at the bad time. And the value of our net worth is so volatile, and it becomes a challenging aspect part of it. So as Warren says, we love low prices. We don't love that low prices because that doesn't come in vacuum. It comes with lot of micro challenges and macro and micro challenges both. So it's not that easy to maneuver with the full-time investors with the whole of the equity. So I thought that okay, yeah, that's the part and parcel of it. But Gaurav was hell bent on finding an answer to that. So as like for me it was too good to be true, so that's why I'm thinking it's an honor as well as little bit irony to introduce Gaurav, because I didn't believe in that Gaurav can find an answer to that. So, and as you know that kind of confidence normally comes when you have cracked actually to the two most competitive exam in India. So I didn't have that kind of confidence also. For me it was like a nuclear physicist trying to find a nuclear fusion answer, reaching for the star. For me it was like you have to go through that journey. But and if Gaurav remember, I called him in Connaught Place and told boss, don't do that, it's a very risky area. But now I have seen it with the options. He's not able to hedge the portfolio so that he can be invested more, and we don't have to be cash for a longer period of time. And you know that bull market are much longer than the bear market, so it becomes frustration to sit on cash also, and it's very difficult to be fully invested at the bad times when the lot of challenges are there. So Gaurav has successfully been able to manage that through options, not only to hedge the portfolio and able to create an income stream out of it. So I hope everybody has his own style. So I hope viewers enjoys that Gaurav journey, and it's an interesting part. Please, thank you, Ankit.
Thank you so much, Manoj.
Yeah, thanks Manoj for the honor of this. But Ankit, truly, if you want to understand the journey, if you find me to be low profile, then Manojji is a notch above me, and his journey is much, much more interesting than mine. And the conviction that he carries is the difference being is that he doesn't believe in hedging. He carries his conviction, and he thinks truly long term. So it would be very interesting to know his journey and how he has performed over the last 2 decades.
Great, great. So over to you, Gaurav. It would be great if you can start with an opening remark before we begin with the question answers.
So Ankit, first of all, thanks for hosting me on SmartSync Services. I have been a silent admirer of your effort and the kind of research you do. And it definitely is a source of stock ideas for me once in a while. So thanks for that job that you're doing around this. Uh, the other part I can think about is once you approached me about talking on this subject, I personally felt that I took a decision to become full-time investor in 2006. I jumped in it, and I had this huge tailwind of multi-fold returns coming before that, and I was just flying in the sky in terms of that compounding money is so easy. And earlier, if I could have compounded at 70, 80% a year, even at 30, 40, 50%, another 10 years, and I'll be in a different orbit. So it's the folly uh, that one carries after having some near-term success. And then 2008 happened. This was a momentous occasion in my setup. It totally uh, screwed all the assumptions I had about investing. And with such huge drawdowns, it impacted me mentally also. And it took me quite some time to come out of it. So it was a painful journey post that, and some of the lessons I learned is something that I would wish on not on any investor. And so some of the learnings I had from that point is something that I've incorporated into my portfolios, and maybe some of those insights and learnings could be of use to our fellow investors. So
Thank
I'll
you.
just keep it at that.
Thank you. Thank you so much, Gaurav, for your generous words. And we all know about, many of us already know a lot about your journey. Like Avdut was saying about you at the start. So let's begin straight away with the questions now. So if I did my research right, you started investing in way back in 1998. I guess you just finished your stint with IIT Delhi and was in IIM Calcutta at that time. And over the next few years, you went on to work with different companies as well. So take us through those early years and how easy or difficult it was to manage investing with your corporate career at that point of time.
So the genesis of that is I did my schooling in Shimla, and my grandfather, my Dadaji, uh, he also again had a very eclectic career, and one of the stints he did was that at some point about 25 years before that, he got hold of the stock Delhi Stock Exchange ticket when he felt it was cheap. While he never operationally ran as a member, but in those days you could lease it out to other people, your seat, and you would get a monthly, a yearly payment for it. And he did that. So, and in the process, he ended up holding some of the shares, the blue chip shares. He had Telco, Tisco, and a couple of L&T. So what happened is when I was young and when I would go to his house, there were these stock annual reports lying around, and I was a voracious reader. My problem was that I ran out of books to read after a point. And if nothing else was there, I ended up reading those. And that's what triggered my initial interest. And once in a while, I would. So my grandfather wasn't an active investor. So it's not like it was a discussion out there, but once in a while I would ask him that, "Oh, what are these and why did you buy them?" And he would have some reasoning around it. So that was the initial spark of interest. Uh, then and the other incident I can remember is that uh, I think in 1991, I Harshad Mehta had come to Shimla, and there was a small news article in the local newspaper. And in Shimla, if anybody has been out there, it's the main mall road that most of the people are there. And I ended up seeing him and having heard the stories about him. It had been a so that just excited me, and that left a imprint that how a person coming out of nowhere is now the talk of the town. So those are the two incidents I remember distinctly. Uh, in So then I got through my engineering exam and came to IIT Delhi. And during IIT Delhi, I got hold of a book called the Warren Buffett Way by Robert Hackstrom. So it was just scanning through the books, and I just thought I'll go through it. And reading it just clicked so many things in my mind. I totally got into the concept of thinking of stocks not just as ticker symbols going up and down, but thinking of the business behind them and the concept of margin of safety. So those are the things that immediately clicked and kind of started me on this. After reading it, I was clear I did not want to go outside India. I wanted to be here and become and study companies, do things. So to that extent, that drove my thought process. Uh, Went to IIM Calcutta again. So it was known for finance. One of the reasons I joined it. But the interesting aspect, I once I joined it, I realized that nobody really practiced investing. People were in the institute largely to get jobs and but the actual practice of investing wasn't discussed or taught in any way out there. So and the other thing in my mind that was playing out at that point was that Buffett used to say that if you are in the thick of actions, you will never have a have the time to think through things or basically stay away from the crowd thinking. So that was the other role. So once I passed out, I decided that I don't want to be in Bombay, and I was looking at other opportunities which could give me. At that time, there were limited opportunities, so I took up this job with KPMG Corporate Finance in Delhi. And so that was kind of the start of the journey. There, I learned about valuation, so Excel modeling and how to build those modeling charts, models, DCF models is something that I learned out there. I learned that, but within a year, I also got an experience which just took away the entire, in my mind, the value of building those DCS. So there was a company called Indian Shaving Products Limited, which was the licensee of Gillette in India. It was listed, and so they had the group had other companies also. There was an unlisted company called Duracell. They had other product lines that Gillette had globally, and while I Indian Shaving Products was quite profitable and doing well, the other companies were not, and they came. So our partner at KPMG got this mandate that they wanted to merge four companies together. One was listed, three was not listed. And while they gave us the exercise. So the partner called my boss, and he took me along with him, and we were told to build the DCF model for that. But at the same time, we were told that you have to arrive at this swap ratio. So the swap ratio was pre-decided, and we had to build a model to justify that. So then I realized that it's not it's simply the tail wagging the dog. So most of the DCF models are built largely to achieve a end objective rather than coming up with any kind of discovery on what the value is. So I stopped doing. I learned it, and within a year I stopped practicing that aspect. And my logic at that time was that try to think of stocks which are not researched and where there will be an informational asymmetry out there. Look at them, try to get a comfort around their business model. And so it was largely a buy and hold strategy that I was trying to practice. So does that answer the initial part of the journey?
Yeah. So one thing probably you missed out, Gaurav, here is I just wanted to understand how easy or difficult it was to manage investing along with your work because you were in a corporate.
Okay. So investing was always my first love. This is something that I learned, and I just realized that so doing the job was largely to get the initial capital. So I'm from a middle class family from Shimla. So the initial pool, my grandfather had some holding which he had passed on to my father, but that pool wasn't too big. So I realized that I need to build a small base of capital before I can ever think of uh, doing this full time. And so this was, and the other part was I was looking for similar kind of role profiles where I could practice both. And so to that extent, it was a conscious decision about working at companies where I could practice on the investing side also. So,
Right. Right. So when did that moment arrive where you decided that this is it? I mean, what led you to jump the ship from a corporate executive to a full-time investor? Try to go deep here, as many in the audience or the ones who will watch the recording are probably at the same juncture today. So the answer to this question will actually help them immensely. I think
so
nobody needs to exactly copy what you did, but probably your thought process will help all of us there.
So yeah, I think it was a confluence of two, three decision points. Uh, I had a good amount of success. There was this massive rally from 2002 onwards, right up till 2007. And at that time, the rally was so strong that it wasn't a skill to compound your portfolios at above 100% a year. So while you think it was a skill, but when you look back and see how other people's journey was, your performance was middling, if not the worst. So to that extent, it was a crazy bull market. So that provided the false wind in my sails in the sense that I thought that I had a lot of skills that I could perform well even going forward. So I think that was one main driver at that time. The second was this was my father health had turned bad for, and I wanted to have the flexibility to go back to my hometown at a short notice and stay there for extended periods of time if the need arose. So that was another angle that I wanted to have that flexibility. And but the final decision point that triggered was that having made the money like this, I felt that I could do even better if I jumped into this full time, which is the biggest folly of my assumptions at that point of time. So so all of these added up in a sense to give me this false confidence that things would be very easy and I could be the next big investor out of India. So and and the interesting aspect is that almost all of my batchmates from IIM Calcutta, I knew of not anyone who was looking at following such approach. Most of them were in corporate jobs and were trying to build their corporate career. And for me, my role models and the people I interacted. The other part was at that time I was pretty young and I had this crazy thought of networking out. So social media wasn't there. Internet had just started, and it was very difficult to go out and connect with people. So I started this Yahoo group called Share Dil, and I would like you do it on Twitter. I would try to capture interesting content from the internet, make a small newsletter out of it, and keep on sending once a week on that Yahoo group. And my opening line to anybody else that I wanted to get in touch with is that uh, if we connect, I will put you on the group and there'll be a value add to you. So in that process, I connected with a number of people, and the final trigger point for me to actually jump full time into it, uh, I got in touch with a couple of HNI of big investors who had just started the process of investing, taking warrants in companies and so significant minority stakes in listed companies, and then working with the promoters to increase their profile and help them uh, raise more capital. And ultimately, the whole idea was that cash them early when the companies were cheap. They were small, raise money. Money will allow them to grow, and then subsequently exit at good profits. So they already had a few successes in that, and they were so in that process they had never made an open offer in the sense that they became an promoter in any of the companies. But then one opportunity came their way. This is a company called Asian Oilfield, and there the company's market cap was so low at the point that when they were looking at investing in it, the market cap was 15 crores. So for even for them to put that 5 crores of money meant that they would their holding would be more than 35% of the total company. So but that was the kind of amount that was required. So Asian Oilfield used to do contract services uh, for ONGC for oil exploration. So they took over, and they had no interest in running a company, and they were looking for a public face who could be represent the company at investor forums, and who could subsequently help raise money for additional money for the company to scale up. And we talked. It came to a point where they said that why don't you join on this one? The existing promoters of the companies were quite old, and it was a matter of time that they would retire out. And the whole idea was that if I could join, scale up the company, and move to running the company at some point. And given the tailwind of my success, and here I was getting a huge set of warrants, and just to join in, I just jumped the ship and joined them. And so I took a huge haircut in terms of my salary, but my payoff was in terms of the 4 lakh warrants I got on the company. And so that was the final thing that prompted me to quit my job and come into Asian Oil. So I joined Asian Oil Field in early 2006, we subsequently went on to raise more capital. We raised about, I think, 45 crores in that company. A private equity guy came in, and and Asian Oilfield also won two big contracts, one from Oil India and one from ONGC. So what they do is these are seismic surveys where you are trying to map out the ground to see whether there could be oil potentially below the surface. But these two big contracts were in Mizoram. One was in Mizoram, the other was in Nagaland. And now I think about it, we won the contracts is because nobody wanted to work out there. So even the ONGC employees, so ONGC had their own captive teams that would do the exploration, but they simply gave out tenders for these is because uh, Mizoram was a very challenging terrain, and Nagaland was something that majority of Nagaland doesn't believe themselves to be part of India, and there isn't any outsider coming into the state. So that happened. We faced a lot of struggle in executing both the contracts, and we ran through the money and struggled with scaling up. And then 2008 happened any which ways, and my warrants came out of the money. My incentive to work within that setup was no longer there. I wasn't getting any salary, so I also decided to quit. And this was before the big crash came, and then subsequently the big crash also hammered my portfolio. So everything just kind of piled off. The perfect storm happened in 2008 for me.
Very, very, very scary to to just think
So
of.
yeah. So again, it's fortune that lifts you to a certain height, and you feel that there is still the a way to go up, and suddenly you lose the ground below you. So and it happens in everybody's life. In some people, it's intense or has much bigger consequences. In some people, the intensity is not so high. But these are lessons that everybody has to learn for themselves.
Right. So, Gaurav, now let's shift gears. I know about your 200 bagger stories. So, you spoke quite a bit on the same in your Stoic podcast with Puneet and Manish. However, there are many of us who have not watched or rather listened to that podcast yet. So, do share your journey with both the stocks as to what was your thought process going into buying them, what made you hold on to them and wait till it became a 100 bagger, and finally, how you ended up selling them. So I would want you to go chronologically. So start with your first stock and then with the second stock.
Okay. So how I wish I would have another 100 bagger post these two guys, but yeah, the journey is like this. The first company that was a 100 bagger for me was Unitech, and this I'm talking about 2002. I had some success investing, and uh, having worked for some time, I invested a princely sum of about 3 lakhs into Unitech. Now, why I invested into Unitech was uh, a year ago back. I had bought a house, so that was under construction. This was a property being built by Unitech in a place called South City 2 in Gurgaon. So that South City 2 project was entirely Unity. And this was almost a 300-acre project. And just the price of the house, I bought my house at about 13 lakh rupees. And so this was one floor on a three-storied unit, and they were building hundreds of such projects. So if you just do the maths and see that, even assume that they are making 15% or 10% of the money, how this will add up over the coming years. So that was a simple maths. I was fortunate enough to actually sit there and live in one of the projects they were developing. I wasn't living at that point, but I had gone out, I had done my essay, and I knew the size of the project. So that was one. Second was that Unitech at that point was trading at a market cap of about 50 to 55 crores. And because of that, uh, and they owned a property called Radisson, which is in Mahipalpur, right opposite the airport. Now, this is almost a 400 room property, and based on whatever my analysis was, just the value of this property, and they owned 63% of it, would be more than the market cap of the company at that point of time. So both these aspects, I just thought that the asset is dirt cheap, and if the real estate cycle is going to start in India, then it will play out. I bought the stock for the first year. Nothing much happened. So again, I bought it at about $60, and from 60 it moved up to 70, 80, and then kind of stayed there for a long time. At that point, there was another set of investors in Delhi, a guy called Abhishek Dalmia. He used to run a small family office called Renaissance, and I got in touch with him. And as I interacted, I also got to know that they had started building a position in Unitech. And so my discussions with them continued. They were looking at my on-the-ground research, with whatever I could pick up, and they provided access to a guy within the company, and he talked about their plans for the future. So that was the kind of asymmetric information, if you can call it, that I got hold of, and then it was easy to hold on to the stock. And the other interesting aspect that kicked in is that so this company Unitech was founded by a guy called Ramesh Chandra. He was a civil contractor, had been doing building buildings in NCR region for 30 years before that. He had two other partners and they had founded Unitech. And the company was scaling up gradually. It's before this, nothing dramatic had happened. But in the last 2 years, they had got hold of this huge land parcel, and what happened is in 2004, his son Sanjay Chandra came back from the US, and he had this big ambitions about what he wanted to do out there. So he bought out the two other partners, and then in conjunction with some people in Bombay, they started buying all the float of the company out there. So the stock then came on circuit, and 2004, if I remember correctly, about from 120 bucks right up till 2000 rupees, it just went up on circuit. There was not a single day when it was not on circuit. So if it's a circuit, it's very easy to hold on. So you don't have to think too much. And then 2005, I had an accident where it was a serious injury on my hand and on my hip bone. And because of that, I was hospitalized, and I was on bed for almost 6 months. And all during this time, my hand was on a cast, and my only thought process is कि यार वो शेयर में क्या हो रहा है कि उसको मैं बेच पाऊंगा कि नहीं बेच पाऊंगा. That was the dominant thought process at that time. So finally, and at that time, you had to give those delivery slips in order when you wanted to sell. So I just wanted to make sure that I could sign my delivery slip and then insure. So 2005, finally, when I recovered, I had sold some amount, but the last 30% was still lying with me. And by the time I ended up selling them, it was a 500 balance. So So that's kind of the journey that happened. So it was nothing but fortune smiling. So I can't really say that when I bought it, it was cheap. There's no doubt about it. But to think about it as a 100 bagger, there was no remote inkling that anything like this could play out. So it was not just Unitech. If anybody who has that vintage, the entire real estate listed stocks, they got dramatically re-rated in that bull run from 2003 to 2006. But the star performer was Unitech in that.
So my follow-up to you would be on this is, had that been no circuit like that, you would have ended up selling the stock
Yeah,
much
I'm
earlier?
pretty sure I would have. So one, because when I bought it, it was about 15% of my holding. And as the holding grew to more than 50%, my thought was that the concentration can't happen so much, and I started selling out. But if it wasn't on circuit, I'm sure I would have sold earlier because nothing would change so fast. They acquired more land parcels. They went on a buying spree, but all of that didn't result in cash flows or revenue. But there, this concept of NAV started getting floated that they are going to buy 2,000 acres of land and on a per square feet value. This is the FSI. This much land will be built. This is the kind of margin they will make over the next 10 years, and then they would discount it back to the current value and say that this is really underpriced. But all that, at least I was very clear, that all that is bunkum. So these things are going crazy. I just need to exit.
Right.
So that kind of it. 2006, I ended up. I think 2005, and I sold out most of uh, Unitech. I had the last 2% just lying there in my account, but majority I had sold. And in the case of in the process, also what had happened with the interesting aspect is because they wanted to bring out the value. They came out, Unitech came out with a 1:5 bonus, 1:4 bonus. So one share would turn into 5 shares, and uh, also split the shares. Sorry, 1:2.
I used to one, it would be.
No, no,
I
no.
used to one.
This is 12:1 bonus.
Yeah,
So one
exactly.
share would get converted into 13 shares, and then they split the shares also into 2 rupees face value. So effectively, one share got converted into 65 shares. So for anybody, so currently and then subsequently also they gave a 1:1 bonus. So when I'm talking about when the share was at 58 bucks, you have to divide it by 130 to get the current value. So that was interesting, and that was the market where any kind of bonus or anything would provide another set of win to the stock price. So anyways, that was so 2006. I ended up selling, and then I was in touch with another a value investor and much respected figure in the NCR region, Mr. Ashish Chog. And now, Mr. Ashish Chog had this habit of exploring all kind of eclectic stocks, and he was a storehouse of information. So his thing is that his coverage is very wide. It's not very deep in the sense that he would know too much about a company, but he would all know about almost every listed stock that is out there. So I was talking to him, and he told me that गौरव यार इसको भी देख ये एक छोटी सी कंपनी है दिस कंपनी वाज आशियाना हाउसिंग और कि तूने रियल एस्टेट में तेरे पैसे भी बने हैं तो इसको जरा जाके देख कि क्या हो रहा है इसमें एंड आई डिडंट know about Ashiana Housing. Ashiana Housing had started out with projects in a place called Bhiwadi. They were building these uh, low cost budget housing. And Bhiwadi is like an industrial town. And it's about 50 kilometers from Gurgaon. and it's an industrial town in Rajasthan, on the border of Haryana and Rajasthan. And basically, building housing was for people who were working in factories in that area and who needed a place to live. So I thought I'll do that, and I actually made a day trip to that place. And one of the things in real estate was that the general assumption was that a lot of cash transactions happen in real estate, and more so in North India than anywhere else. So the general assumption in real estate was that whatever the profits are there for in a particular project, the minority shareholders won't see that because most of it will be siphoned off through cash transactions, and that held true for majority of the companies, and that's one of the reasons that those companies were never valued. So, so one of the things, I went there and I met the sales guy and acted as a buyer and said I wanted to buy. And they quoted a price of the this is 4 lakhs, this is 5 lakhs. And I told him that यार कुछ cash में भी करा दो, मेरे पास cash पड़ा है. And the guy would then said कि नहीं यार sir वो हम नहीं कर सकते, हम cash नहीं ले रहे. And I tried. I went to through a broker. So the broker told me that we don't deal in Ashiana because they only sell directly. So these were very different aspects which I hadn't encountered before, and that started got me interested. And then I wanted to meet the management. Now the guys running it. This was a person called Mr. Om Prakash Gupta. He had migrated from Patna and to here, and they operated out of a small house in South Delhi, in a place called Masjid Mon. But it was impossible to get out to them. For 6 months, I tried trying to get in touch with them, and finally, I posed as a customer, called, and I said I wanted to talk to the owner, and I ended up speaking to his son, Vishal Gupta. And hearing so I just blurted out that I'm not a buyer, I just wanted to talk to you. And we ended up speaking for the next hour. And that conversation was so insightful in the sense their philosophy around building and why they don't want to take cash and why they ended up being in Bhiwadi. It just convinced me that this stock is for the long term. And the stock was so illiquid, and it was at that point at a market cap of 12, 13 crores. That it was amazing. So for the next 6 months, I bought whatever I could in that particular share. And but after buying that, so sorry, this entire thing started happening early 2005, and by 2006 end, I had bought what I could, but nothing would happen. I also talked about this share to Mr. Abhishek Dalmia. So Mr. Abhishek Dalmia then negotiated with one of the erstwhile shareholders uh, who held the shares from the time of the IPO of the company. And in a block deal, he took that entire chunk from him. So he also became an interesting party. And then he proposed to me, why don't you convince these guys to start doing investor relations? So because nobody knows about them, we understand how they are running a small company efficiently. So I went out, Mr. Abhishek set up a meeting for me. I went out and pitched to them that these are the things that you guys should do. So I wasn't saying that I will do it, but I just said that these are the things you have to do. And those guys turned around and said, why don't you do it for us? So, so I said that I'm already doing, this is not a full-time job for me. So but post once the crash happened in 2008, I finally reached out to them and said that I'll do it. And that's
Gaurav,
how.
there is some problem on the voice from your end. Maybe something has just changed.
Is this better?
Yeah, now it is much better. Yeah.
So yeah, so 2000 2008, I picked up their IR mandate. So I was an investor. I was their IR consultant, and then the journey started. And finally, all the efforts for the next 3 years paid off big time in 2012 when finally institutional buyers started buying from it. So when I bought, it was an 11 crore company, and 2013 the market cap crossed 2,000 crores. So in between there are many interesting anecdotes and stories, but here my advantage of never thinking about selling it before that is because I effectively was an insider. I knew about what the plans were and how they were playing out. And see, in real estate, there is an interesting aspect. Uh, the accounting happens. The accounting that Ashiana followed, there were two ways to account. So let me say the accounting that Ashiana followed was that the revenue will only be recognized once they give the handover of the property to the owner who has booked it. So in a year, if they say that we have booked 6 lakh square feet or 8 lakh square feet, the revenue of that would be recognized over the next 3-4 years. So you could know the sales, all the sales that haven't happened in the past, and you would have an idea when the deliveries are happening. So you can easily model out when the revenues will be recognized. So all the sales that happened in 2008, 9, 10 started being accounted for in 2011 and 2012. And the numbers came out and the stock just shot up. And 2012 was when two mutual funds also bought into it. So it was easy to hold on to that particular story. But there is also a corollary to this. 2007, in the middle of it, I had bought whatever I could of Ashiana, and since I was so enamored, at one as so in the fag end, the stock also shot up, and at one point, Ashiana became 70% of my portfolio.
And stock 70%.
And then the 2008 crash happened, and there was a 90% drawdown in Ashiana. And I was that's part of the other journey, that if a stock having that kind of a weightage then crashes so much. So it taught a lot of things about risk management, which I have subsequently applied, but at that time it was a pretty painful journey.
So, Gaurav, you said that it was a 12 crore, 13 crore market cap company. So I'm assuming you would be holding more than 1% of the company at one point of time?
Yeah, at one point, I was owning close to 2%, yes.
And since both your 100 baggers have been real estate companies, would you throw some light as to how do you value real estate companies? As in, what should we look at? If I say have to value a real estate company, how would you suggest me to? What would be my tools?
So yeah, we mulled over this issue when I was doing IR for Ashiana. So I no longer am doing it now. So we just realized that the accounting, when accounting profits, when they are reported in the balance sheet and the P&L account, they are not a true measure of the economic value that is being added. So we started telling investors that these are the 3-4 things you should measure. One is the bookings that happen on a quarterly and a yearly basis. Those booking numbers every company shares. And now the booking is just nothing but an initiation of the contract. So at the point when the booking happens, the company will only get 10% of the contract value upfront. Now, earlier, what used to happen is that pre 2016, companies could book a flat, and people would take a home loan, and 90% of the property value would be given upfront through the home loan. And so the cash flows were front loaded for the developer. Now, post all the issues that came up with the real estate, uh, the mortgage, the home loan NBFCs and banks, they moved to a model where they said that the disbursements of the home loan will be linked to the construction. So as the construction milestones are hit, only then they will disburse the additional amount. So one, that thing has happened for the better. Earlier, what used to happen is that the developer would propose a project, say there are 300 units in that project. For almost 250 units, they would get the cash upfront, and rather than redeploying the cash to build out that property, they would go out and buy another project, land for another project, and so that's how it that started happening a lot. So now it's much more disciplined. So anyway, coming back to what happened with in the case of a real estate company, one is to look at the number of units sold or booked in a particular period. That is one. Second is we came up with a term called equivalent area constructed. So this is a term that in Ashiana presentations you would come across this term. So this was a contract that was derived. So the broad construct of this is that it's equivalent to the percentage completion of, if the total project value is 100, what percentage of that is has been constructed already. So giving weightage to certain different parameters, we would come up with a number which would add up to a certain area in square feet. So we would say that in this particular quarter, equivalent area constructed was 1.2 lakhs or 1.5 lakhs or whatever. So that's the other measure we started giving out, and we asked the investors to track that. The third measure we started reporting was we call the operating cash flows. So operating cash flows, they come once every 6 months, but we report it every quarter. So, but not the technical definition of how it's reported in a balance sheet. So operating cash flows for real estate companies would take out the payments for the land bank if they have bought any in a particular quarter or a period. That money would be taken out of the operating cash flows. So we reported cash flows adjusting for that. So that we are saying that whatever amount we received as advances from customers for final payments for the units that they had bought, whatever came from the customers, minus all the expenses of extra construction, minus all the corporate expenses, whatever money was left after that, that was the operating cash flow. And in case
also minus the land, you mean?
Minus the
Also
land,
minus
yeah. So land payments are bullet payments that may get front loaded in a particular quarter. So in order to for you to measure what was the cash flow generated in that particular quarter, that had to be subtracted.
Just a follow-up here, just to make it more clear to our audience here. Is it right to think, Gaurav, that the land, they used to think that the land payment has to be deducted because of their thinking that land is basically an inventory, right? It's a raw material. So that is how you, when you calculate operating cash flows, basically what you do, you take care of your working capital requirement, right? You adjust the working capital. So is that the reason why the land was?
Yeah. So see, more than that, see, ultimately that inventory is also going to be consumed and will be recognized as expenses. But see, what happens is that, say you have an operating cash flow of 20 crores in a particular quarter, and you end up paying 40 crores for a land parcel in that quarter. That means on strictly the accounting basis, it's minus 20 crores cash flow, which doesn't really reflect the reality of that particular quarter versus maybe 15 crores cash flow in the previous quarter. So for a like-to-like comparison is why we started taking that out. But ultimately what happens is like in a project, uh, the cost of the land is accounted for in the P&L at the time of giving possession. So once you give the possession, so all of that is deducted, and so it gets expensed out in that P&L statement, and simultaneously it gets reduced from the holding inventory. So that's largely the reason. But what I'm trying to say is that these are the metrics that we said that you could account for. Another metric that wasn't reported out there, but I would use myself was I would on a rolling basis, I would say the sales, what is the booked inventory over the last 3 years, and track that rolling inventory every as it gets updated every quarter, and then say that with the basic assumption, all of this revenue is going to be recognized in the next 3 years, and use that as a recognition tool and see that what kind of revenues would come in the coming year or coming. It was never quarter to quarter because sometimes the handing over of the project also happened, got shifted from one quarter to the other quarter because OC didn't come or some other approval didn't come. So there's no point thinking about quarter on a real estate company. You have to take a larger view and broadly have an idea where the numbers will come. So you broadly, if you had bumper sales in a particular year, you could say that 2 years to 3 years after that, all of this will start reflecting in the reported numbers. Now, and the general market, if it's not thinking like that, when those numbers get reported, the stock gets re-rated. So you buy and you wait out for those numbers to come, and they would come as positive surprises to the market, and that would drive the stock price up. So
Right. So
yeah.
So since both your 100 baggers have been from real estate sector, it would be fair to ask you what is your view on the real estate sector now, and do you still hold Ashiana? Because I think you sold out Unitech long back, but Ashiana, do you?
So Ashiana, I hold out. So 2013 was a time, and since I was an insider, I had to take approval also. So I took the approval, and 2013 I sold out 80% of my holding. I held on to 20% of my holding, and which was a mistake. So 2013 to 2020, the stock only went one way, which was down. So that taught an important lesson to me. Is one, I knew when that stock was expensive, why didn't I exit? The other aspect is that it also highlighted that real estate is a very, very cyclical sector. The cycles last longer, but they are cycles. So after, for whatever reasons, there is a huge downturn in real estate from, I would say from 2015 onwards, 14, 15 onwards. The prices of real estate, the actual per square feet prices haven't gone anywhere till about a year back. It's only in the last year that prices have started moving up. But all of that price hike is largely driven by uh, cost inflation. All the components that go in building a house, there has been a huge price inflation over the last, especially the last year. Steel, cement prices, energy prices, manual labor, all of these have shot up. So my take is that most of it is the current price hikes are just reflecting the cost inflation that has happened. There is a good amount of appreciation that could kick in. We have seen about 8 years of the downturn in real estate, and the next 5 to 10 years could be pretty good for real estate. So that's the broad hypothesis. Real estate stocks have the highest weightage in my portfolio. And Manojji is out here. He's a much bigger bull on real estate than me, and he can explain things much better than me now, given how much tracking he does. So we discussed it a lot. And now my holdings are not concentrated in a single company. We have a portfolio of companies. So we have Godrej, we have Ashiana, uh, we have Kolte Patil, we have Shobha. Uh, Manojji, anything else you want to add out here?
Let me just
Yeah.
mute Manojji. Yeah, Manojji, please go ahead.
I think we have summed it all. We have Obroy also a little bit.
So, Manojji, share your views about, now that we are discussing about real estate. So, just share your views about what you think will happen over the next 5-7 years.
So the perennial bull story in real estate comes from the urbanization. So if you are from Shimla and you are doing some IIT, IIM or whatever education you could do, so you will move to the four cities: NCR, Pune, Mumbai, or Bangalore, and Chennai. These are the five cities which will give you ample opportunities of the job. And actually, if you have to follow the real estate, you have to follow the mantra, follow the jobs. Which are the cities which will give you the job? And in the long term, most of the developed countries have 50% urbanization, and we are around 30-35%. And we are culturally inclined to buy real estate also as a one big asset class. And this asset class has not performed from the last 7-8 years because it's a cyclical industry. It performed from 2004 to 12. Now there is an assumption that real estate prices has gone up because of the inflation. But actually, but that has triggered one thing, that prices are starting to move up. And anybody who was sitting on the fence that the real estate prices will never move up has shot up by 15%, 20% in a year. So now they are feeling the pain that, okay, this is the assumption which might not go for a very longer term. And this is a good asset class. People are thinking after COVID with the work from home and some security it provides as an asset class. And in the time they spend with family, it is not about rent versus EMI calculation. Because if you see that now inflation was a low part of our life earlier. Now, if you see inflation as a rental as an inflation parameter also, then you cannot compare EMI with rent, because rent is inflationary and EMI is not. It's a fix for the next 30 years. So we are following some where these developers who are concentrated in these 4 or 5 cities, who have a good sale engine, doing all the business in white, and suddenly, if you see, it's a difficult industry to be in. One needs 360-degree approach. One has to have good land buying mechanism, good sale mechanism, good building mechanism. With that kind of difficult industries, ROEs has to be good. And for the last 7-8 years, ROEs are bad. So I am assuming that next 7-8 years would be a different ballpark game.
So, Manojji, you know that I've been trying to get you on our platform for real estate sector only. I would like to request in front of everyone again today, why don't why don't we have a webinar on real estate where you actually give much more detailed insights onto how you look at this sector. I remember you sharing with me a 2015 report also, which was very good. So I would request you again, if whenever it is convenient for you, if you can come on our platform and we can have a much more detail, that would be really great.
Sure, Uncle.
Thank you.
Yeah, thanks, Manojji, for the insight. So again, so our views totally converge on this. Manojji has a much longer view even than me, even though I ended up making money in some of those stocks. See, and the dichotomy in my mindset, real estate as an asset class is something that I don't like personally. My issue about real estate transactions is the transaction costs are pretty high. You have to pay brokerage of 1%. The stamp duty is so high. So real estate can only be thought in terms of a buy and hold strategy. You can't just buy and sell real estate like you do in stocks. The second part is that there is a huge counterparty risk in real estate, especially if you're doing a secondary market transactions. Even though the initial handshake happens after taking the small introductory amount, which is we call bayana here in North India. But I've seen enough transactions fall through after that. So the buyer or the seller is kept hanging for multiple periods of time. The other is the illiquidity of the transaction. Say you are interested in buying a property uh, in a particular condominium, and you go out and say, "What's the price?" Say the broker will quote it's one CR or 1 crore, and then you go to the same broker and say, "I have a unit in that condo. I want to sell." Then the quote will come at 80 lakhs, 85 lakhs. So there is no transparency for you to understand what is the real price out there in the market. And so my personal view is I don't want to hold any real estate in my portfolio. I own the house I live in. I own an office where I work. But beyond that, I don't want to hold any real estate. And I'd rather hold real estate stocks than real estate. So that's the approach I have.
Yeah. So before moving on to next questions, Gaurav, I remember in one of our interaction you mentioned that actually Manojji helped you change your thinking about only focusing on Ashiana and then having a diversified portfolio of all these real estate companies. Could you touch upon a little more on that as
So
to why?
yeah, so it was obviously driven by what Manojji. So as Manojji says, pointing out that uh, real estate is one of the sectors where the headwind and tailwind is much more important than the individual performance of a company. Uh, when I invested in Ashiana, that I clearly knew that their ethics level were high. They don't deal in cash. But what has happened in terms of the cleanup in the real estate sector over the last decade or so, where many unscrupulous elements have been pulled out. RERA has come into play. So now manipulation is not so easy, and all the a cleanup has happened to a large extent. And now the corporate governance of the listed players is a lot better than what it used to be. And so rather than saying कि इसका corporate governance better है, let's assume that most of them have similar corporate governance. And it's very difficult to say out that which particular company will perform better than the other companies. So it's better to take a basket approach. So that is one thing. The other thing that Manojji highlighted and he said so earlier is that the trend globally is that population is migrating towards mega cities. So in India, the demand for real estate in say a Bombay or Delhi NCR is going to be much more than say a city like Shimla. So and Ashiana focuses on tier two cities more than tier one cities. So if one wants to play that trend, then Ashiana is not the right play. So given all those aspects, and obviously talking to Manojji a lot has changed my approach. And then the final lesson for me was that there's no point having a single stock as 70% of your portfolio. So now real estate is almost 30% of my portfolio, but it's divided between five stocks or so.
Yeah. Thank you so much, Gaurav, and thank you so much, Manojji. So moving on to the next question. In that Economic Times article of yours, it was mentioned that you bought into Syndicate Bank and JP Associates in 2012 and 13. Can you elaborate what was your thesis and what were the key learnings post the whole experience? I'm asking this because your experience and learning may help us become a little better in our journey too, as we keep on making those kind of mistakes much more frequently. So
So okay, so to get into that, both these stocks were part of the covered call strategy that I run through options. So let me just step a bit back and try to explain what covered calls is all about. So so as I said, 2008 was a bad time to and in 2009, so this big crash came towards the end of it. September and October of 2008 is when the crash happened, which totally changed my thinking about how to manage risk. So the first impact it had was that it stunned me into inaction. I wouldn't buy, I wouldn't sell. I would just keep staring at the screen. And I spent maybe I think till December I would do nothing and just glaze at the screen. And then finally I realized that I need to get out of this phase of mine. And January of 2009, I started looking for a job because I just at that point the view was that the entire financial system is going to crash, and it's just been put up on a patchwork, and things could collapse at any time. That was the prevalent thinking at that time. I started looking for a job. I wouldn't get any. Things were so bad that hiring for a job was out of the question for most of the people. I spent 2 months, 3 months trying to do that, and the job offers I got, I wasn't really interested in those. So then, in March of 2009, I told my wife that uh, because you told me I'm looking for a job, but give me a year. And now that whatever has happened. Give me a year and let me see what I can learn more. So before this crash, I had this assumption कि भैया मेरे पास IIT है, IIM है, जब मुझे जॉब मिले ढूंढनी होगी मिल जाएगी. And those 3 months taught me कि यार there could be times जब ये भी नहीं होगा. And that broke my shield and my high ground about that I'm entitled to certain things. So I started from scratch, and then I started reading about other things in a very intense manner. So this is April 2009, right up till end of the year. So I read a lot, and I would scour the internet as to what was happening, how people were coping up, and I
Gaurav,
came across.
sorry, I'm interrupting. Just wanted to know from a percentage basis, where did your portfolio go from 2000, say somewhere around 2004 to 2007 high, and from 2007 high to this point, which you are talking about, 2009, just in percentage term.
Yeah,
You have to
so it's difficult to highlight कि कितना है. So, but
ballpark. I'm not looking for exact numbers.
yeah, so if you say that from when I started out, I started putting in serious money in 2002. So my portfolio would have jumped about 20x in 2007, from 2002 to 2007. And then from 2007 high to the low point, which was I think in Jan and Feb. I stopped looking at my portfolio values, but my portfolio drawdown was 80%.
80%.
80%. And the only asset I owned outside the stocks I had was my house, the house from Unitech that I had bought. And so if you consider that also, my net worth was down more than 75%. So it was a huge drawdown on the net worth, and that's what impacted my thinking at that. So yeah. So coming back to where I started, so as I was scouting the internet, I came across this interesting website where so I had studied options during my college days, but never really practiced, and options till that time weren't very popular also. So then I came across this lady. So there's this middle-aged lady is in her late 40s, sitting in a small town in Canada, and she ran this blog called fullyinformed.com. And it's paid blog now, but at that time everything was available for free. And she would explain. First of all, she explained her covered call strategy, but more important than that, she explained how she managed the 2008 crash doing this. And I scout that website for all. I think I would have scanned more than 99% of the website, everything that was out there on that website in terms of how she's uh, thought about things. So one of her golden rules was she wanted. So Let me first explain what covered calls are. So covered calls are simply basically buying a share and selling calls on top of an equal amount, so that when you are selling a call, you get a certain premium as a seller, and that premium is in case that call expires out of the money, which means the market price of the stock is below that strike price of that call, then it expires out of money, and you get to keep that premium. So it will take a lot of time to get into all the nitty-gritties, but if anybody is interested, I would recommend them to first understand options. And the interesting metaphor that one can use to explain options is that an option seller is like an insurance company. He's selling the coverage of a certain risk, and he's getting a premium for that. So the exact the very good comparison is that uh, think of an option seller as an insurance company and an option buyer as an insurance buyer. Now most of you would have a car and you buy insurance on top of that. Now, why do you buy a insurance? You buy the insurance, you have to pay a certain premium, which could be 10, 20,000 a year. And why are you paying that? You're paying that just to have the peace of mind that tomorrow, if an accident happens or your car gets stolen, the big loss that comes with that is taken care by somebody else. And in order to have that comfort, you are ready to pay that premium, which is on a yearly basis. Now, so that's the thought process of or insurance buyer. So insurance seller is just a business. It's an insurance company that is selling that car insurance to say 1 lakh car owners, and with the assumption that only 10,000 or 1,000 claims will come around an accident or a theft, and which they are willing to pay. So all the premium income that they get minus all the claims they have to pay, minus their operating expenses, is their profit. So that's their underwriting profit that they have. So similarly, an option seller can think of himself as a insurance company who's selling these insurance to all the option buyers, and with the basic assumption that if he's diversified enough, that the claims that will come on him in a particular month or a particular year will be limited to a certain extent, and all the premium that he is getting minus all the claims he has to give out, if on a residual basis it's a positive amount, so he's making money. So that metaphor, I think really helps in understanding what is happening when people sell options or buy options. So covered call is nothing but basically buying the underlying share and selling options on top, and then trying to make money out of that. So this strategy is something that was practiced by that lady. One one of her big checkpoints was that she would only do it on blue chip companies, so-called constituents of the S&P 500 in the US. And her idea was that if it was a blue chip, it's a dividend company. It's a very low probability of the company going price going to zero. And in case the stock price corrects, then you keep selling calls on top till the point you are able to recover the drawdowns. So I personally got enamored by that idea. I started doing it in a small basis. Over a period of time, I got a hang of it, and now I really do it at scale, uh, having learned about a lot of those aspects over the last 12, 13 years. So coming back to the example, so that gives a brief history about how I got into option selling. Coming back to the example where you said about Syndicate Bank and JP Associates. Uh, First of all, they are not blue chips. So and now the question being asked is then why did I get into those particular two companies if I wanted to do? See, in blue chips, say when we say the blue chip in Indian context, it could be a Infosys or TCS a Reliance or a HDFC Bank. The blue chips, what happens is that since the movement in those stock prices are so low, the premium on their options is also very low. So if you're selling covered calls, you want to generate a certain amount of premium because you're playing for to make money out of those premiums. So that's one of the reasons. Earlier, I would when I started out, because I thought I was more intelligent than the lady who was doing it. I thought that I can manage the downside and let me look at the stocks where the premiums are the highest. Now the premium are the highest in stocks where the volatility is the highest. So especially in JP Associates, that journey is also interesting. So JPA Associates was a EPC contractor who had seen its glory days in that 2005 to 2008 period, and since then it had fallen. But they owned a lot of real estate assets in the NCR region. They built the Yamuna Expressway, one of their subsidiaries, and they by default, because of their setting with the UP government, they really owned a lot of assets. And one of the few things I think that distinguished them uh, was that they were good at execution versus many of the other players of those vintage. I personally really like their execution. They built those two hydro projects, which were there in JP Power, on time, on schedule, and within budget. So I was impressed by their capability to execute. So what had happened in JP Associate, uh, the company was talking about getting more into EPC, and they did a QIP at 80 rupees, and they raised about 3,000 crores at that time when the market cap was closer to 20,000 crores. And so my take was that if they did the QIP at 80 bucks, I started selling the 70 strike puts. Uh, now the discussion will get a bit technical. I'm not sure whether people will understand that, but I'm starting with the assumption that people will. If you don't understand what I'm saying right now, I would request you to do some homework and see how the payoffs happen in calls and puts as to. So I'm not going to get into that detail because that will take us on a different tangent. So I sold the 70 strike puts at $4, so which was a pretty high premium for a monthly option. And but what happened is that the stock tanked immediately after that. It fell to almost 60 rupees from 80 bucks. And on puts which I had sold for $4, now there was a loss of 20 bucks. So the strategy in covered calls, what I do is that I convert the puts into futures. I bought futures at 60 rupees for the next series. And then I started selling the calls on top at 80 rupees. So I could still sell the 80 rupees calls at 2 rupees. So this continued. But what happened was that there was this crackdown about funding these EPC companies. There was a lot of contingent liabilities in their balance sheet. And the stock kept correcting and correcting. And I had this notion in my mind I can defend any stock to glory. So the stock kept correcting. I bought more shares at so initially when I started the stock was at 80 bucks. Then when it corrected to 40 bucks, I bought more shares and kept selling calls on top. The stock kept correcting. And then at that point, it came into my mind that I will only leave this trade once I recover my all my losses out of it. So I continued that trade for 3 years after that. And finally, and I would track every month what is my PNL on that particular trade, starting right from the beginning where I started from. And finally, when the stock price was at 13, I broke even. And that is the time I just exited. So I felt good that I could, the stock corrected from 80 to 13 bucks and I still came out without having a loss. But what I didn't realize at that time was that there's a huge opportunity cost. It took a substantial part of my mind share just trying to manage the share. and I lost many other opportunities just trying to manage this one trade. So an important lesson learned, but still there is pride in the fact that I broke out even on that particular trade. So that's the story around GP Associate. Syndicate Bank uh, was always the story about PSU banks, which were much cheaper than the private banks. I thought about building a portfolio of PSU banks. Syndicate was the cheapest I found. I thought I can easily manage covered calls, but the stock kept correcting. I kept holding. So there, but I wasn't fighting this. Syndicate Bank then ultimately got merged into something else, and that's the time I exited that. In Syndicate Bank, I had to book losses.
So, if I understood you correctly, I think you would have broken even on the JP Associate trade by 2016-17.
Yeah, somewhere around 2016, yes.
With the benefit of hindsight with me right now, if you'd have left that trade somewhere in 2013 itself,
Yeah,
2013 was probably a very good time to look for bargain hunters, right?
So in my mind, see, Ankit, in my mind, my covered call portfolio and my stock portfolio are two very different holdings. So I'm not aiming to jump between one or the other. So in my covered call portfolio, if I had exited JP Associate, I would have bought some other share, but only for the covered call. So to that extent, it is there. One of the important lessons that I have learned is because these are derivative contracts, futures and options. Uh, for my covered call portfolio, I've also learned now to hedge the overall exposure. So when I say hedging the overall exposure, I now buy Nifty puts as protection for that overall portfolio. So now those drawdowns, in case they come, don't hit me so hard as they used to earlier. So that's the new aspect that I learned post that March 2020 correction that I've incorporated, and that has been a big help.
So, moving on, Gaurav, any other recent examples in the last 5 years which come to your mind where you were very confident, just like in case of JP Associate and Syndicate Bank, and but it backfired?
So again, JP Associate and Syndicate Bank were part of the covered call. Here, I don't need to have a high conviction. I'm more driven by what premium I'm getting on their calls. So I wouldn't equate them with high conviction ideas. It's just that they were two stocks in my portfolio of 15 stocks, which didn't do well. Now, coming to your question, which was a high conviction stock and which didn't well. So there's a company called GMR Infrastructure, which again has a similar vintage as JP Associates. Took a lot of debt and built many good assets. But again, I was enamored by their execution skills. The fact that they owned two world-class assets in terms of the Delhi airport and the Hyderabad airport, and how they have been running it. So since I'm based out of Delhi, I travel through that airport. And if anybody of you has traveled through those airports, you'll realize that even at a global level, they're pretty good assets. So I always thought that those assets can be valued pretty well once all their past uh, infractions can be wiped out. They carried a lot of debt on their of their at the corporate level, and the they had power assets which were again bleeding money. They had road assets that were bleeding money, and they had all this debt. But the jewel in the crown were these airport assets. So I had this chair is an FNO, so I've been doing covered calls on it for the last 7-8 years, and I understood, and I used to listen to every con call they had, everything that they had to say, and I was pretty convinced that traveling through air will take off in India. It has a long runway ahead, and the stock there was a bankruptcy risk, and at one point, as they gradually divested assets and kept paying off their debt, at one point I was convinced that the bankruptcy risk has gone. And now I felt that the asset was pretty cheap. And then over a period of time, I built a big position on it. And to think about it, in 2017, it would have been 20% of my portfolio. And so it was a high conviction bet. And if you see globally, there are many listed airport assets globally, and they command a very high multiple in terms of valuations. So my take was that once all these other things that will get cleaned out from the balance sheet, so divesting of assets and reducing debt, and we as investors would always go out and propose to them on the con call saying that you should demerge the airport assets out of the main company, to which they said they'll look at it. And finally, they said that we will do it. So as of today, GMR is airports is a separate company. Yeah, the other assets are in a separate company. But so I was playing on the story. I was thought that I had studied the asset pretty well, and then they had won this bid for Goa Airport, which I think is again a very lucrative asset. So my assumption was that there's a long runway I can hold on. And then suddenly, what happened was COVID hit, and COVID was virtually a showstopper for air travel. And there was the uncertainty, and then I realized I had this 20% weightage, and this particular company is going to be hit so bad. And again, in my mind, the bankruptcy risks again started emerging, that how they're going to fund all the expenses with virtually zero revenues. So I divested some of my holdings. So that was one big bet that finally I didn't make a loss on it, but it didn't play out. There was a huge opportunity cost on it. So
Right. I think I read that in your Economic Times article as well. At that point of time, maybe in 2017 or 18, you were very, very, very bullish on the road and infrastructure space at that point of time, right?
more so on the airport space, but road, I had another holding called PNC Infratech. I really liked their execution, so I held that asset, those shares also.
Right. So, Gaurav, very, very few investors invest in the market the way you do. We have long-term investors, risk arbitrage players, technical traders, momentum players. Each one of these have their own way of doing things. However, I personally don't know of anyone except you who practice three styles together. Your long-term investing, then risk arbitrage, and then you also have this option trading. So if you can take us through your journey as to how did this evolve. Some of it you have already discussed in the previous question, but how these all three, because I remember you saying that it all started with that Warren Buffett book you read, and then probably something happened to you in 2007-8 where you were probably having a high concentration in one of the stocks in your portfolio, and then post that. So how this all, and I'm sure when you started even in 2007, 8, 9, trying with all these different ways of investing and what you are doing today, there has been a huge evolution of you as an investor. So if you would want to share something about that, that would be really great.
So yeah, Ankit. So the evolution, I started out as a typical so-called value investor. When I started out, I was totally enamored by Warren Buffett initially, and subsequently by Kali Manjan. And I really appreciated the way they had built their business and the way they talked and thought about it. And I practiced that for a long time. So for me, the big change came after the 2008 crash, and where I just realized that investing. So yeah, the important lesson one of the important lessons I keep talking about is I learned. So being totally enamored by Buffett, I used to consume everything that he had to say or write, or any article on it. One of the things that had stuck on my mind is that Buffett used to say that Berkshire Hathaway is 99% of my net worth. So in my mind, I always thought that if such a great guy can have 99% invested in a stock market, so what's wrong on me being 90% or 95% invested? I'm starting my career, there is a long runway, then this is the time to compound. So what I didn't realize and which I subsequently did was that his 1% at that time was also worth $200 million, which was not in the market. And my 10%, which is outside the market, was nothing but a house I lived in. So where would I, all the other expenses would be taken care of. So that particular aspect I totally missed out on, and this is something that I would highlight to all the other investors who aspire to be a full-time investor, that your nest egg should be enough to sustain you even if you are not successful in investing. So if you don't have that nest egg, and if you're dependent on your investing skills to run your day-to-day expenses, then it's a huge risk that you are taking, which may come back to bite you at some point. So that's a lesson learned, and it has greatly influenced my thought process since then. Now I'm at a stage where I have enough money outside the market that even if all my invested capital goes to zero, I can still maintain my current lifestyle just out of that. So I don't want to risk that capital into the stock market. Even if it earns 1% return, I'm okay with it. But this particular strategy has given me a huge peace of mind. I'm not too bothered about what is happening out there. And in my mind, even if something like 2008 happens all over again, I can handle it now.
From 90% equity investment, as in 90% of your portfolio invested in equity, how much of it would be invested in equity today, roughly?
So broadly, yeah, I don't own real estate. I own real estate in the sense I have this house, I have another office. But I would say that at any given time, 70 to 75%, I'm still invested in equity. But within equity is there's an important. I have built this covered call portfolio, and that covered call portfolio is almost 50% of my invested capital. And covered call portfolio, as I highlighted to you, was hedged now. That is hedged. So I can't have big drawdowns on that portfolio in any, even if the market crashes to whatever it did. So my risk capital, if I can say so, is now maybe between 40 to 50% of my net.
Right, right. So Gaurav, you have been investing since the last 24 years now. And in the long-term investing bucket, how does your process work like? As in, take us through your screening process, your research methodology, and anything else which you think we should know to understand your long-term investing process. Maybe in terms of how do you judge the business and how do you judge the management?
So yeah, again, this is an evolution that happened. When I started out, I would get hold of Capital Markets. I subscribed to that magazine, and not too many people would be aware about that particular magazine. But at that time, you didn't have active internet or information on the net, and this Capital Market was was a magazine where uh, it had almost 30 pages of listing of the companies. What you today see on screener, that data was published on a monthly basis or fortnightly basis in that particular magazine. So it became a good ready reckoner for you to see where the valuations are and see. So I started out with scanning through that and seeing where the low valuations are. Now all of that job can be done through those screeners, which are available on so many websites now. So I would try to find out what are the cheapest assets or the cheapest companies, and then try to look out which is the one I want to own. So initial philosophy was to buy something that is cheaper than anything. So I was totally contrarian, and then wait for the re-rating. It played out initially uh, till it stopped playing out. So in that 1998 to 2007, this strategy really played out well. And I had plenty of 10, 20, 30 baggers during that rally. But again, as I said, that wasn't skill. That was, you were just lucky to be in that period. So, so I started out with that. But post the 2008 crash, and having trying to follow the same approach, what I realized was that uh, there were so many examples where I thought the assets were very, very cheap. You were buying them at 10, 20 cents to a dollar in terms of the replacement cost. And then you're waiting for the re-rating to happen. It played out somewhere, but in many places it didn't play out. And then the gradual approach was towards buying growth at reasonable valuation, which is the gap investing. So then I would say that I'm not looking for the cheapest assets, but I'm looking for good quality companies with good managements, and even if they are not the cheapest, I will prefer to buy them vis-a-vis just the cheapest assets out there. So that is now I would broadly say what my approach is. That I'm not looking for the cheapest assets, but I'm looking for companies that have shown good behavior on part of the promoters, and also uh, outperformed the industry when the times were tough. And if they are expensive, as long as they are not too expensive, I'm still open to looking at. What I realized also is that the Indian market values growth above anything else. Any company, no matter how cheap it's there, if the general perception is that it's not going to grow, the stocks is going to stay in the dumps. So look at the valuation that the PSU stocks command, and they look cheaper. My personal thing is it ended the career of a guy like Prashant Jain, who carried this kind of conviction. But his funds hugely underperformed because of the high weightage he gave to PSUs. So that's the evolution out there. And then I have friends like Manojji, like you, and countless other people who are now idea generators for me. So we keep on discussing, and some of the stocks we deep dive. The other aspects we have learned over time is that we end up speaking to the managements if wherever we can have access to them. We would want to understand their thinking, their plans for the future, and whether we buy into those logic. So now since we are full time, then that's one aspect that we try to figure out. But to say that original thinking where see, like Ashana was something that I think I was one of the earliest guys. Maybe I was told about that idea by Ashish Chuggi, but Ashish Chuggi never, he just bought it because it was cheap. He didn't understand what was happening in the company. I always think that I was the first one to discover what was happening out there. But now, given so many of us are now tracking ideas, internet has made information so democratic, and there are enough people who are doing this full time. Now it's very difficult to find such ideas which are undiscovered and can absorb the kind of capital that we guys have. So now one has to compromise and learn to say that it's okay if we are not the first. As long as we like the idea, we'll allocate and we'll try to write this.
Any couple of examples you would like to share where things worked really well in this frame, as in 2012, 13 to 22, where you use this GARP principle and it worked fantastically well?
So one idea that comes to mind is a company called Green Panel. So there was this company called Greenply. So and they carried two demergers. So one demerger happened where Green Lam, the laminate business, got demerged out and got listed separately. Subsequently, the Chacha Bhatija Jodi, they decided to part ways. So, and the Bhatija was getting this MDF business. Now, MDF business is very cyclical, and globally, what was happening is that MDF panels were replacing plywood in a big way. Globally, like MDF consumption was is 60 to 65%, and plywood consumption is 20%, 20 to 25%, and then there are all other kind of materials that are out there. But in India, uh, at this, I'm talking about 2017. Plywood was 70% of the market, and MDF was less than 20% of the market. And these guys had the largest plant in MDF. But what had happened is that there was Century Plywood had gotten into it. There was another unlisted company, Action, Tessa, which had commissioned a plant. And since these plants are so big that the capacity so capacity increases as a step function. And so there was largely an oversupply, and that caused the prices to crash. And at one point, these companies were losing money. So they had announced the demerger. Since I play special situation, I was tracking it, and when the demerger happened, Greenply's stock was at 130 bucks. I bought the share of the combined two companies, and the demerger was in 1:1 ratio. And post the demerger, Green Panel listed at 35 bucks. And so what happens in spin-offs is that the company is too small and people are not interested in the company. All the institutional guys sell. So the stock came down on circuit from 36 bucks to as low as I think 24, 25 bucks. And one could have bought all the quantity they wanted. And so I doubled down on my holdings. I added up to it. And then then I got the opportunity to actually go and meet the they used to do con calls, so it's not like the story wasn't known, but I went out. So the interesting perception about the promoter was that he's a page three guy. There was a newspaper article saying that in Singapore he was caught doing cocaine, and that once he got the helm of the company, he's just going to mismanage it. So that was the general perception when I talked to other people. But when I met this guy, he was so hands-on. He had a CFO sitting with it, but 90% of my questions were answered by him, even the financial ones. So I just realized that he's deeply involved in the business, and he's got a much better handle. And what he pointed out was that the demand for MDF is growing at 20% a year. There is a oversupply, but we are going to do our first price hikes, which meant that tides were changing, and that gave me the conviction. So, and subsequently, things played out very well. It's been almost a 30 bagger. I mean, I've exited it now, but yeah, that was one story which I had high conviction that played out.
Great, great. So that is why I asked you to give an example, so that because these examples are much more vivid and it stays with us. तभी वो learning ज़्यादा clearly distill होती है हमारे लिए. So moving on to the next question, Gaurav. So your presentation at IIC on special situation is a must watch, and most of us, if not all, have actually watched it and learned a lot from it. In fact, two of our Mission Smile members, Avdut and Vikas, extensively practice special situations. So maybe at the end, I'll ask them to chip in with their questions, as they might have a much better question to ask than me on this subject. However, I'll ask you a very simple question. As in, if you can explain what, why, and how of special situation to a beginner, then what will you say?
So yeah, special situations are basically uh, events that are driven by corporate actions. And some of the attributes, if I can say so, of a special situation is that they are precipitated by some kind of corporate action announcement that is done. So the various kind of special situations that you can think about is mergers, demergers, rights issues, buybacks. Uh, what else? So delistings, offer for sale, warrants, IPOs. IPOs, I considered IPOs to be special situation earlier. I don't think so. They are now. And then large dividend payouts. So it's a eclectic mix of corporate actions that can create situations where you end up making. There's a high probability of making money. Uh, Also, I haven't said this earlier, but I think I should. I'm not a SEBI registered advisor, so all of this that I'm talking about is for educational purposes and not to be taken as an investment advice at any point of time. So just a disclaimer. So special situations is something because of the nature of their characteristics, you can allocate higher amounts of money than you do to a normal stock allocation. And because they have a timeline, you have a deadline as to about when you will know whether you have made money on this particular transaction or lost money. The probability of making money is much higher than losing money. That's not to say that you will never lose money in such a transaction. So uh, the gist I would want to highlight is that you might end up losing money on one transaction, but on a portfolio level, uh, when you've done multiple transactions in a year, you will invariably make money. At least my experience since I would say 2004 onwards is there has never been a year where I've lost money across the across all the transactions for the year. I have enough examples of places where I've lost money because something unexpected played out or I underestimated the acceptance ratio or overestimated the acceptance ratios. But broadly, I've always made money in any given year. The challenge with special situations has been that earlier the frequency was higher, and because it wasn't so well understood, the opportunity was there to make good amount of returns over a period of time. Now it's become a popular strategy. Many people are doing that. Like buyback tender earlier, retail accounts, because there was a reservation for buybacks for retail accounts less than 2 lakhs. The acceptance in buyback tenders was much higher than the actual acceptance in a particular offer. So people like me, we used to use 10, 15 family accounts to do tender those 2 lakh points. And there were many times when the acceptance was even 100% on that. So you made flat 8-10% on those tenders in a period of couple of months. So, but now the brokers have made it so popular. They offer it to all their clients, and now, in fact, over the last 2 years, there are many buyback tenders where the retail may have lost money. So, because so many tendered. So, so that's broadly the gist. In terms of giving a specific example, something that is live right now is these two open offers, which is Ambuja and ACC. In Ambuja, the stock was at $350 when the announcement was made that the open offer will come at 385 by the Adani Group. One could have bought as much shares as they wanted at $360. The general assumption among the practitioners, I'm part of a group where we discuss special situations, and the general assumption in that group was that Adani doesn't want to get too many shares on the from the market. So at some point, the stock price will breach the open offer price. And that is exactly what has happened in the last 10 days or so. The stock currently is at $420. And if anybody who had bought at that 350, 360 levels would get a 60 rupees, which is about 16, 17% return on as a higher allocation they might have wanted. Because here the downside till the time of the open offer is there is very, very limited. Even in the entire correction that happened in March, April, May, I think the announcement for the open offer came in April, if I remember correctly. Uh, the stock price never went below $360. So you have defense against all the downside that can come in the stock market because of this, whereas the upside is reasonably good. And people like me, we like to allocate high. So in my case, I had allocated 20% of my portfolio onto. Not to say that I got the entire gain because I had sold 400 strike calls. So the move from 400 to 420, I missed out on because the calls were sitting on that. So that's broadly. It's an entirely different topic to go into detail in terms of what all things you can do and track. But as long as you are aware about these situations, uh, and so I have an old presentation on this, Ankit. I can mail out that PDF to you. You can share it with the other members if you want.
Yeah, that would be great, Gaurav. And so we have spoken about your long-term journey. We have spoken about your special situation, and something which you said just a little while earlier, and it just flashed a bulb in my head when you said that option selling is just like selling insurance. Actually, I could immediately think of what Warren Buffett, Ajit Jain, and Berkshire's long history we have read on the Buffett letters and so many other places on the internet, right? So I have a very simple question to you because I have never done any kind of option trading and all. So I'm someone who has been a long-term investor for the last 10 years. If you have to explain to me in simple words the benefits of option selling and why I should probably test some water there, what will you say? And how will you convince me, basically?
So, first of all, there is this general perception that by selling options, you are taking a huge amount of risk because the upside is limited in terms of the premium that you've got. That is what you're going to get, which is the maximum upside, whereas the downside could be humongous. So, in terms of that, if you're selling a call and just say, just to give you an example, say Infosys is currently at 1600. So suppose you just sell a call of 1700 and suddenly something happens in Infosys and the stock moves up to say 2000 in a matter of couple of days. Then what you're saying is that by selling a 1600 call, you might have generated 10 rupees of premium, but you let go of that 300 points move between 1700 and 2000 because of the large move. Similarly to what I lost out when I sold the 400 calls on Ambuja. So, so there is this perception that you're playing with fire or you're picking pennies in front of a boulder in the sense that You're trying to gain 10 rupees, whereas the potential of losing money could be 500 bucks also. So that is one perception that generally most of the people have. Many financial advisors also give that as an example. But my learning is that uh, in options, there are many ways to control your risk. Okay, so suppose giving an example of Infosys where you sold the 1700 call and the stock is at 1600, it starts moving up. Suppose it reaches 1650. Now, there are many ways for me to balance out my position. I may simply cover my 1600 call. I book my losses, which could be I sold it at 10 bucks, I covered it at 30 bucks, 20%, 20 rupees. But there are many other ways to do it. Basically, 1600 call I've already sold. I buy the 1700 call. So now my losses are capped to only 100 bucks. So in case, and if the stock continues going up beyond 1600, I can sell the 1600 put. Now, if I have a call sold at 1600, if I have put sold at 1600, I can only have losses on one of the options. I can't have losses on both the options. So one can be used to defend the other. So there are many ways to manage your positions to kind of reduce your losses in case the trade goes against you. And this is something that we have learned and done over a period of time and kind of got comfortable with the entire set of strategies. Now, for a beginner who wants to get into options, I definitely believe that options can be used to generate income. So I can I can say with a 99% confidence that my option portfolio in any given year will not result in a loss. Now, with the kind of allocations I do, that's a tall order of comfort for me. And so to that extent, I've learned to manage risks over a period of time. But so that's the comfort if one learns enough. Uh, so so one of the benchmarks I have on my option portfolio is in my option portfolio, I don't want to have a negative year. That's first rule I have. In my option portfolio, I want to outperform the Nifty returns by at least 5 to 10% every year. So whatever the Nifty returns are, I want to outperform that by 5 to 10% on a year-on-year basis. That coupled with the fact that I will never have a negative year is a good enough outcome for me to run a big portfolio on options. So that's the evolution where I have reached things. For a beginner, anybody who wants to delve into options, so options requires monitoring. So it can't be something that if you're doing other things and you say that I've sold options and I can just sell them and forget about them. So one has to monitor. It requires monitoring, and because of that, it requires a certain level of commitment in terms of watching your position. Now, if you're not doing it at scale or as a significant portion of your portfolio, then it's just not worth the effort. So first of all, you have to learn it enough to get the comfort to allocate a material amount of your portfolio to this. If you're not willing to say or you find it too risky, you should not delve into it. And for you to make that transition from finding it absolutely risky to the point where I think I have reached is going to be a drawn out journey. For options are much more complex than trading stocks. There is much to be learned, not just in terms of terminology. There's so much of terminology out there that a person who's starting out will get confused with the terms that experienced traders use. So one has to pass that bridge of learning all that terms. And the second is to experience all those scenarios and to live through them in order to understand how to manage your positions when the trades go against you. Like I'll give you an example. We have tried to teach multiple people, good friend of ours, where we genuinely wanted them to learn this in order for them to generate incomes. We would simply explain to them. Earlier, we proposed that come to our office on a daily basis, which was not really feasible for them to come every day. So then we decided that, okay, let's talk on the phone. You just, we'll explain what we are doing and you replicate. What we realized over the next 3 to 6 months is that their performance was much lesser than ours, is because some of the adjustments we did, they just did not have in them to execute those adjustments, because maybe they didn't understand the risk we were taking, that or they didn't have the experience when they felt that the market was turning volatile and there were unexpected losses, they would just make their position zero and just book the losses. So so we have realized that one has to experience it, live through it in order to do it. But what anybody who's willing to take that journey, I think it's worth it. One can deploy large amounts of capital. One can generate. So our benchmark is to generate 18 to 24% annualized. We've been doing better than that, and we don't know how long those returns can be generated. But for now, we have bet those. So 18% returns annualized over the last decade. We have bet those benchmarks. So to that extent, that gives us the comfort. But if somebody says that I just want to learn and there's no point monitoring one sold call on Infosys and spending so much time analyzing it unless you want to do it at scale.
Right.
So does that answer your question?
Yes, Gaurav, very, very much, very much. And so it gives a very good framework as to how you should look at this space and all. So that is what actually I was looking for. So before I move on to the next questions, I just wanted to share with you that we have already gone past 1. So I hope it is fine with you if we can continue for more 15, 20
So
minutes.
about another 15, 20 minutes, if that's fine, says if we can try to wrap up by 2:30 or so.
110 right now.
Oh, sorry, 110. So 130, 140. So
okay, 140 is last. So I'll probably ask the most important one. So my next question would be, so if you were so good at finding great businesses, you were good at special situation, and then you also ended up doing so well in option trading as well. Why didn't you start your own fund or PMS? So that is a natural question which came to my mind, and then I coupled it with this. Is that have to do anything with your experience of 2008, or there is something else?
yeah, so it does have is something to do with 2008. I used to manage, so I didn't have a formal license, but I used to manage money for some of my relatives and my friends. Pre 2004-5 onwards, I started managing some pool of money, and basically the idea was whatever I was buying and selling, replicate the same with them. So one is and the idea was that if I do well, then I'll look for a formal management. So after the initial success, first 2 years were good, and then more and more people started approaching me about managing the money. And so my way of managing money is I would ask them to open account on ICC Direct and they give me the password. So everything was in their name. It was a 3-in-1 account in the sense that the demat account, the trading account, and the bank account was all in ICICI group, and I could do the transactions by just logging in on their behalf. And so as the number of accounts increased, once they crossed 20, I just realized that it's such a tedious exercise to log in, to track, and then see all the executions that happened, that it became very dairy after a point. So that was one pain point that I felt. So given the rewards, whether I wanted to do these kind of things. But more important than that was that once the 2008 crash happened, it just shook up my confidence so much that I just realized that if I'm not able to manage my own money that well, what right do I have to manage other people's money? So after the crash, as soon as the negative returns vanished from those accounts, I just handed them back, saying that I don't want to manage it anymore. So that process, and the experience was so everlasting. I thought I'm better off not managing other people. So 2008 was there. Uh, in options, I'm much more confident and comfortable doing things. But unfortunately, there is no structure that is in compliance with SEBI rules that I can use to manage other people's money. So if there was a structure, I would have thought about it. For now, there is none, so I don't have an.
Okay. So I think I'll ask this one last question before we move on to the audience for a few questions. And this is probably my most favorite question. If you were to start investing with a very small capital of say 5 to 10 lakhs today, what would be your investing strategy?
Yeah, with 5 and 10 lakhs, see, I would definitely, having learned more, what I've learned is I would immediately start delving into options because I personally feel that. But 5 and 10 lakhs are too small an amount to think about managing that particular money. So I guess for options you need to have a pool at least of 50 lakhs given the kind of margin that is required. So it's not about the margin of the initial trade. It's also about how you need extra margin in order to manage it in case the trade goes against you. If you don't have the capacity to manage it, then those losses will happen when the trade goes against you. So maybe with 10 lakhs, options will not be an option. Uh, but in terms of investing, I would say relatively build a concentrated portfolio. Now, see, the context is also 10 lakhs for somebody for whom 10 lakhs are very important and they can't afford to lose it. Then it's a different approach versus 10 lakhs for somebody who says that even if it goes to zero, then it's a different approach. So people need to understand their risk appetite. If they're at the start of the journey and people are doing other jobs, then I would broadly be open to the idea that even if I lose these 10 lakhs, I can live with it. If you can't live with it, then any of the things I'm highlighting should not. In fact, one of the big rules of investing is that invest only that capital that you don't need it for the next 5 years or are okay with having drawdowns. If you have an issue with facing drawdowns, you should not invest to start. So people have to understand their own psyche and their uh, ability to handle drawdowns. So again, I was introduced to this term by Manoj Bhai only. There is a term called uncle point. So uncle point is the amount of pain you are willing to withstand in terms of drawdown on your any kind of drawdown in the value of the asset class. So so suppose your portfolio is at 100 and you behave rationally till and then the portfolio starts going down. So and says at 80 rupees, I raise my hand and I say I can't bear it. इसको खत्म करो. Just cut the losses or 80 rupees मुझे वापस करो. So 80 is my uncle point. Uncle says makes fun of me and says that oh why did he start investing if he can't bear it? So Ankit keeps on investing. But when that 80 becomes 60, becomes 50, Ankit will also raise his hands कि यार कुछ गलत हो रहा है, बेचो इसको. So that 50 is Ankit's uncle point. And then Manoj ji will laugh because I discovered this concept and those guys don't really understand what they got into. I can stand. And Manoj ji is laughing, but when the that 50 goes down to 40, 30, or maybe even 10, at that point, Manoj ji will say कि भैया भैया मेरे को कल स्कूल के पैसे भी देने हैं फीस के भैया ये कहाँ जाएंगे काटो इसको. So everybody has their uncle point. Point is that you need to understand your uncle point. So everybody needs to know that, and accordingly they have to build their investing plan. So people who are starting out early should be open to the idea that even if they lose money, it's okay. It's part of that. See, investing is all about making a hypothesis and then waiting for your hypothesis to play out. So you can say it's your effort, it's your research, but you can't underplay the role of luck. It has to be that has to kick in. Why you chose a particular company, or it was in a particular sector where suddenly headwinds turned into a tailwinds, or vice versa. You couldn't have predicted it upfront. You couldn't have predicted that suddenly the promoter passed away or something happened. All of this is sheer random luck. So one has to give enough credence to for the luck element in anything one is doing. So once you start on that journey, one you have to invest, and you also have to factor in for the fact that things may not work out. So this is the broad philosophy, and again, 5-10 lakhs. My broad approach would be to I still love small cap stocks, so I would want to invest in stocks, a relatively concentrated portfolio of 10 stocks, 1 lakh rupees each, in stocks which are under researched, where I feel that I have a view which is not being understood by the market. So does that answer your question?
Yes, Gaurav, very much. And now, in the interest of time, I'll probably open up for some questions from the audience. I have a few questions, but I don't think then the audience will be able to ask any question. So I think, Falak, you had a question in mind. So I've just unmuted you. You can go ahead and ask your question first. And others can also raise your hand. I'll come back to you. Yes, go ahead, Falak.
Yeah, is my voice audible?
Yeah.
Yes, it is.
Yeah, good afternoon, Gauravji. Thank you for the detailed insight and in-depth journey.
Thanks, Falak.
And I also like the idea of covered call. I will study first on that. We'll try to do paper transaction, and then we will try to implement if it suits me. But thank you for the suggestion and idea.
Sure.
I have a question, Gauravji, that I believe you are more focused on the subjective aspect of the company. You are tilted more towards the subjective part rather than the numeric part. So what are the few pointers that you look for in the company or in the management? A thumb rule, if any thumb rule do you have that these are the things we must look it into the companies?
So, Falak, see, I did not highlight the financial aspect because financial aspect is available to anybody who's willing to go out and look at the financial. That's a place called screener.in. So the kind of data that is available till 10-15 years back, that data wasn't available to all and sundry. People had to buy databases in order to get access to those kind, and those databases were pretty expensive. Even in 15 years back, those databases used to cost 80,000 to a lakh rupees a year. So in order to do that kind of analysis, it's only the set of people who are willing to spend that kind of money and effort. Now, all that information is available just at a click of a button. So the value of you finding something just by looking at financial data, which is underpriced, uh, is is uh, is much lower than what it used to be. So that is one aspect. The other aspect is if there is a lot of value in something, and and it's out there for everybody to see, and still it's not being valued properly, then the question you need to ask yourself is, what is it that the general public knows and I don't know? So one of the basic theses that I have learned or started believing in is that market is right most of the times. market is not right some of the times, and it's not easy to figure out what are those some of the times. If you always say that I'm contrarian, I will buy this stock which is cheap because the market doesn't value it properly, sooner or later you will get humbled. I got humbled clearly post the 2012 time, where I thought I'll buy deep value, and market is silly not understanding this deep value. It will get re-rated. Some of those stories did get re-rated, but my performances was much lower than the performance of some of my other colleagues and friends who would invest in growth rather than anything else. So that is one angle. Coming back to the qualitative aspects is that yes, over time I have started playing the qualitative aspects, give much more importance. Partly that is also driven by the fact that now we are full-time investors. So we have much more time to devote to following up with companies, listening to their con calls, attending their AGMs, doing scuttlebutts in terms of talking to their suppliers, their customers, and also trying to see how the trends for raw material and the end products are in order to find out how the spreads are going to move. So all those analysis is also a function of uh, our ability to devote more times to certain things. And in terms of the qualitative aspects, the single biggest qualitative aspect that I have started giving credence to is the quality of the management. For many people, the quality of management, or for I would say that for many promoters, they don't consider the fact that the company is listed. Even if they own, say, 40%, 50%, or for that matter, 75% of the company, they believe that the company is theirs, owned by them, and 100% ownership of the cash flow is theirs. So they're willing to do whatever they want to. So until unless that mindset is there in the mind of a management, as to say that I'm part owner, I'm not the total owner. And if the company is doing well, the other part owners also need to be rewarded. If that mindset is not there, then even when the good times come for the company, the promoter will find a way to siphon off all the excess cash flows. Or if he doesn't do that, now it's increasingly getting difficult to siphon off money. It used to happen a lot earlier. Otherwise, he'll think of it as a private company. So if say somebody is a retailing company, they'll end up getting into manufacturing कि भैया मैं कपड़े खरीदता हूँ, चलो मैं ये कपड़े बनाने ही शुरू कर देता हूँ, खरीदने क्यों है. So they will get into all kind of diversifications, as we call it, simply because they feel कि भैया our decision, why do we need to even think about pros and cons. So I remember this company, VRL Logistics, the operationally it's run pretty well, but then the management came on record and saying that uh, we want to run an airline. Now, if you have this fetish or this desire to do something which is foolhardy, do it out of your own money. Why do you want to do it out of a listed companies whose an airline is something that could take away the entire profitability and the balance sheet of the existing business? We have seen enough stories. So what the management desires and what are their actions? So there are two ways to judge that. One is many of the companies now do con calls. The promoters come on TV. You can scout them and find all those interviews. So you can hear them out and then come to a conclusion whether you like what they're saying or not. The second way is also to see, go back 10 years into their annual report, see what they are saying in their MDA, and whether that has happened or not. So just don't focus on what they are saying, but also focus on uh, their actions in terms of have they delivered what they said. So
Okay.
I hope that answers your question.
Yeah. Thank you. And just one last question, if it is possible.
Go ahead,
Say-
Palak.
Yeah, thank you. Since you invest a lot of funds in small companies, right? Small companies have a tendency that they might lose a big market share against the bigger ones. Say a small NBFC whose cost of funds are higher may lose out in competition with the big banks.
Mhm.
So this type of risk prevalence in small cap companies. So how do you judge this aspect of these companies? Because the management are pretty good, they execute it well, but they lose out to the big guys, to the big companies.
Yeah, so the basic starting thesis of investing in a small cap companies is that since their base is small, uh, if they are good at execution, the products are good, products or services are good, they should grow faster than the industry average. If they're not growing faster than the industry average, then as you pointed out, they are at a competitive disadvantage. So so economies of scale, while they play out, there are many economies of scale also. So it's for you to make the judgment whether what is playing out in which way. As you said, if there is a consolidation in the market and market leaders are gaining share, then it doesn't make sense to invest in the smaller companies in that space. So that is one aspect. The other aspect is the other point is valuation here. So if a NBFC is available at 0.5 times books to me versus buying AU Finance at 6 times book, then just see the scale of difference in valuation.
Okay, thank you.
Thank you, Falak, for asking the questions. So, Pranav, you can go next. I'll just unmute you. Yes, Pranav, you can go ahead.
Uh, Namaste, Gauravji. Thank you very much for such an insightful session. My question is there any book or any other resources that you would like to recommend for options for someone who already has a beginner level knowledge?
Yeah, options के लिए more than a book. So Eugene Sinclair की किताब है. So it will take some time for you to understand the terminology. So Eugene Sinclair है, मतलब I can find some names, but frankly I can tell you that मैंने कोई किताब पूरी पढ़ी नहीं है. So my learning has been more out of watching videos. So two sources of videos that I would recommend is there is a website called Tasty Trade in the US. They make a lot of informative videos about for beginners about what a strategy entails. These videos are 5 to 15, 20 minutes. It's so just take them on a you can cover in a systematic way. You can cover. The other very good resource about options is Zerodha Vasti. They they're from scratch. They have tried to explain a lot of things about options. Uh, for many people, just going to Zerodha Vasti and going through all the write-ups they have done on options, uh, I would assume that you will really understand things after that. The other source that has been helpful and I still consume is there is what's this guy? So face-to-face interviews. There are these interviews face-to-face by one Mr. Bajaj, and he has interviewed tens and tens of option traders and the strategies they follow. And there the traders also highlight the strategies they are following and how it's worked out for them. So typically these interviews are about an hour long. So one can go through some of those interviews in order to understand. So anything that is being spoken in those interviews that you don't understand means that go out, search on the internet, understand those terms to the point where you get comfortable what's being talked about.
Thank you very much.
Thank you. So, I think we'll take last two questions now, since it's already 1:30 and we have overshooted the time. So, Gaurav, you can now go ahead. Yes, Gaurav, you can go ahead. I have unmuted you.
Hello.
Yeah, please go ahead.
Thank you, Gaurav sir, for this insightful. Uh, just a quick question regarding special situations. Like
Gaurav, I
many
can't
times.
hear you clearly. So your voice is floating in and out.
Hello.
Hello.
It's clear now.
Am-
Yeah, you can.
Okay. Thank you, sir, for this insightful seminar. My question is regarding special situation. Sir, what I have seen is many a times these kind of situations arise in micro cap stocks. And like out of like in the way that capital infusion through preferential shares or by open market offer, these are some kind of special situation that arise in micro cap. And like there are many such opportunities that takes place in this sector, in this micro cap segment, sir. So how to go on with this thing or learn something regarding this in this area?
So, Gaurav, what you call as special situations, typically I won't call them as special situations.
Okay.
So special situation is more driven by a corporate action which has a defined closure date. So so open offer would count because open offer will come in the future. It has a certain period of tendering and then it will close. Merger is announced. There will be a formal date for a merger date, and subsequent to that, the two companies will trade as one. So similarly in demergers or buybacks or everything. What in micro caps when the preferential happens and a new set of investors are coming in terms of so you're saying that the future may look a lot different because this new promote set of people have come and the company plans to either grow much faster in what it's doing or may enter a new category of business altogether.
Yes, sir.
Those are interesting investing opportunities, but I would not call them special situations.
Okay.
So that is not a category. So if you are getting into that, how do you say that when is your exit time? When does the corporate action end? So for a special situation, the corporate action has to have a certain defined date where the entire special situation ends. All these things, what you're saying is that it might improve the prospects of the company in the future, but that has nothing to do with being a special situation. So does that answer your question? So again, that's a style of investing where a new set of people
Yes,
are
and
coming.
just
Yeah. So I'm saying it's just a style of investing where people enter when a new set of people are coming. But such things happen a lot in the bull market. As soon as the bull market is over, it's extremely difficult to make money out of. In fact, you'll feel that I'm stuck in such things. So this is more a bull market strategy than anything. My learning, your experience could be somewhat else. So does that answer it, Gaurav?
yes, sir.
Okay. Ankit, I can't hear you now. I can hear you speaking, but I can see you speaking, but I can't hear you.
Okay, I was muted by mistake. So, Avadut, I'm unmuting you. You can ask the question.
Hi, Gaurav sir. Thanks for giving us the time. Like it's been almost 3 hours and elaborating everything in detail. That's very helpful. Two questions from my side. First, any new set of special situations you have come across recently? Just like there could be RE, rights entitlement, or the second one could be a company doing a IPO for its subsidiary. That has happened recently in the many cases, like KDDL doing a IPO for Ethos, or Inox Wind is trying to do IPO. That there are multiple reasons why Inox is trying to do IPO for Inox Green. So any new kind of special situations that you have come across?
So again, I'm not an investment advisor formal, so it's not in my thing to say that water can work or not. But yeah, one of the things that I'm currently doing is Piramal Enterprises. There, the demerger date has been announced just 2 days back, where the pharma business and the NBFC business are getting demerged. I think the record date is 1st of September.
Right. Yes.
Right.
So you think that smaller part will be NBFC arm? There could be a selling coming into over there.
Very difficult to predict, yeah. But if it's an FNO, so I'll manage my risks. So point is that you don't know the outcomes. If the outcomes were so sure, I would sell everything else and just do this one trade. So just to say that what I think will happen will actually happen, it doesn't make sense. You have see, when you're trading options, you're doing these situations, you're handling probabilistic scenarios, and you're assigning probabilities. And if your analysis is right, the probability of that happening is higher than the probability of something else happening. But that doesn't mean that it will always happen.
Understood. Understood. That's it. That's it from my side. Thank you.
So, Gaurav, before leaving us, I really want to thank you for such an insightful session. And in fact, I have a few more questions. We could have gone on and on, but in the interest of time, we'll stop here. But before leaving, if you have anything to advise or suggest to me, my team at Smart Sync Services, or our Mission Smile members, that would be really great.
Ankit, it's not that I have a lot more knowledge than any of you guys. It's just that my journey may be a bit longer than yours. All I would say is that investing is not anybody's cup of tea. Anybody who hopes to become successful, in my humble opinion, needs to be passionate about what he's doing. So get into investing, trading, or trading options or whatever, only if you enjoy the entire activity. If you don't enjoy it and you just feel that money can be made, I can guarantee you that one, it will be a painful journey. And if you're not passionate about it, you don't enjoy it, then in all probability, you're not also going to make too much money. So that's my learning. So जैसे हाथों की सारी उंगलियां बराबर नहीं होती, सबका इंटरेस्ट भी एक चीज में सेम नहीं हो सकता है. For me, it's been a journey. Why I enjoy doing it over, say, a job is, so I give this example to my family when my wife says that कि तुम इसमें इतना घुसे क्यों रहते हो. And my thing is that जब मैं जॉब करता था, तो जैसे ही 5 बजते थे मुझे होता था 6 बजने हैं, मेरे को जाना है, और मेरे को बस यही होता था कि बस जाना है. अब मैं जब ये काम कर रहा हूँ, मुझे पता ही नहीं चलता कब 6 आके निकल गए, 7 हो गए. It's just that something or the other is being happening. So more than the process of making money, it's the journey that I enjoy. Talking to like-minded people, seeing, playing out, making hypotheses and seeing those plays out. And I just enjoy that entire process. I clearly understand that this is not for everybody, and one should not just be attracted to it just because one thinks they can make more money out here.
Thank you so much, Gaurav, and thank you so much, everyone, for being patient and listening to this 2.5 hour conversation. Thank you so much. With this, we end our 4th Investing Carva episode. Hoping to meet you again next month with the next episode. Thank you, everyone, and thank you so much.
Thanks, everyone, for hearing me out, and wish you all the best.
We'll share the recording very soon. Thank you.